Hi, I'm Adrian Helfert, CIO of Multi-Asset here at Westwood. We wanted to give you a quick market update. There's no shortage of catalyst of activities going on with geopolitical risk, with the Fed, with real assets moving. We wanted to give you an idea of how those things can impact your portfolio and the kind of moves that we're making in order to capture opportunity in this environment. Of course, we had the State of the Union last night with President Biden speaking. It's political theater, to be sure, but of anything notable out of that, it was his focus on inflation. The populace has looked and said inflation is deleterious effects on the consumer. It's bad. The central bank is saying similar things, and we're seeing supply chain issues coming out of geopolitical risk from the news cycle of Ukraine and Russia right now that are very dangerous for further rising inflation. Now, that may be cost push inflation, meaning it may be short term inflation, but at the same time, it still has those deleterious effects on the consumer. It's something that we need to consider how to bring back down in order to keep purchasing power reasonably strong. So we had the State of the Union today. Fed Chairman Powell is going to address the nation in the semi-annual testimony to Congress from the Fed. That's something where he'll give an indication as to the trajectory or potential trajectory of interest rates. Right now, we're expecting right around 5 interest rate hikes this year. And we'll get an indication of how much geopolitical risk is a consideration for the Federal Reserve. If we see war worsen in Eastern Europe, is that going to be something impacting the decision matrix for the Federal Reserve? That's going to be important for what markets think about the possibilities going forward. If you've watched me previously, you've seen me call this pulling the punch bowl. When the Fed starts rising interest rates ahead of pro-cyclical environmental prowess, that's pulling the punch bowl. That's saying the party might be over, or at least we're not going to facilitate the continual asset price rise by low interest rate policy. That's a difficult time to be an investor. Now, there are opportunities amongst all this. There's something called the broken window theory. The broken window theory is when the window breaks in your house, you need to hire someone, you need to buy the new window. There's services payments, there are goods payments that happen. We're seeing a little bit of that in the environment. You see that with hurricanes, where growth can materialize afterwards from the hiring, from the purchasing of goods. We're going to see some spending changes as a result of the geopolitical environmental change that we've seen as a result of Ukraine and Russia. That's why we've seen defense stocks do so extraordinarily well. The supply chain issues themselves mean that real assets are things that are moving up as wages go up, moving up as inflation goes up. That's real estate, that's gold. Right now, that's energy prices. All of those things can benefit from the environment we're in. They can remain protective at a minimum over inflation. So in our multi-asset funds, one thing that we are doing is we are strategically overweight energy. We are strategically overweight real estate prices vis-a-vis home builders, via real estate investment trust in certain areas. At the same time, we've added to our gold exposure via gold miners. Right now, they pay an income, and they're a very interesting prospect. They have strong balance sheet, yet they're invested in the yellow metal. When gold goes up, they go up. Gold is a long-term inflation protection asset, and it's something that we have in our multi-asset funds that we hope will help us protect from some of the difficult prospects of inflation. At the same time, we've been reasonably conservative in investment profile because prospective growth is taking a breather. Consumer sentiment is taking a little bit of a breather as we evaluate what this looks like. That's why volatility has risen dramatically. The fear index of VIX is up and reasonably elevated because we're all looking and saying maybe we should reevaluate the risk premium we attach to stocks. For that reason, of course, stocks have come down significantly this year. We've kept a conservative profile in advance of that. At some point, spending in new areas. That may be spending in defense, that may be positioning for inflation, that may be some of the consumer coming off the sideline again as we further reopen that we have been expecting for years now. At some point, liftoff will be strong. As investors, we're looking for the new areas to capture that rising tide. But for the moment, we remain conservative. We look for opportunities, and opportunities exist, but they may not be in the usual places we're looking. We hope you enjoyed this. We look forward to speaking with you soon. Have a good day.